Are you a landlord? Then you'll want to make sure that you're not paying more tax than you need to. Today, we'll break down the basics of landlord tax and the key expenses you can claim back in just a couple of minutes. When you rent out property in the UK, your rental income is taxable. But the good news is you don't need to pay tax on the full amount you receive. Instead, you can deduct allowable expenses before working out your tax bill. So, what counts as an allowable expense? General maintenance and repairs, like fixing a leaky tap or repainting walls. Utility bills and council tax, if these are your responsibility rather than the tenant's. Insurance policies, such as landlord or building insurance. Professional fees, including letting agents, accountants, or legal costs. Services like cleaning, gardening, or advertising your property for rent. But remember, improvements don't count. There's also mortgage interest to consider. Landlords now receive a 20% tax credit on mortgage interest and other finance costs, instead of a full deduction. That's an important change to factor into your sums. In short, keep clear records, know what you can and can't claim, and you'll avoid paying more tax than necessary. For tailored advice, it's always best to speak with a professional accountant. Contact us today to see how we can help with your property business. Thanks for listening, and subscribe for more simple tax tips.